12 years. That's how long it took me to stop treating indicators like magic and start using them the way professional traders actually do. And if there's one indicator that's been misunderstood more than almost any other, it's the stochastic oscillator. Most traders use it wrong. They see the indicator move above 80 and instantly think, the market is overbought, time to sell. Or it drops below 20 and they think, it's oversold, time to buy. And then they wonder why they keep getting stopped out. Today, I'm going to show you how the stochastic oscillator is really meant to be used. Not the social media version, not the clickbait version, the professional version. We're going to cover crossover signals, divergence signals, market context, and how to identify high probability setups that actually have an edge. Let's get into it. Rule 1. Understand what the stochastic oscillator actually measures. Before you can use it correctly, you need to understand what it's telling you. The stochastic oscillator does not measure trend. It does not predict the future. It measures momentum. Specifically, it measures where the current closing price sits relative to the recent trading range. The indicator moves between 0 and 100. When it's above 80, momentum is strong. When it's below 20, momentum is weak. Notice what I said. Strong momentum, weak momentum, not overbought, not oversold. Those labels have probably caused more losing trades than anything else. A market can stay above 80 for weeks during a strong uptrend, and it can stay below 20 for weeks during a strong downtrend. That's why blindly fading these levels is a terrible strategy. Rule 2. Trade stochastic crossovers only in the direction of the trend. This is where most beginners make a huge mistake. They take every crossover signal they see. Don't do that. A crossover happens when the fast line crosses above or below the slow line. Many traders treat every crossover as a buy or sell signal, but professional traders add one simple filter: trend direction. If price is making higher highs and higher lows, focus only on bullish crossovers. If price is making lower highs and lower lows, focus only on bearish crossovers. For example, imagine a stock is in a strong uptrend. Price pulls back for a few days. The stochastic oscillator drops below 20. Then the fast line crosses above the slow line. That crossover is happening with the trend. That's where probabilities begin to improve. The trend is your friend. The crossover is simply your timing tool. Rule 3. The best crossover setup happens after a pullback. Here's something many traders never realize. The strongest stochastic signals rarely happen at the beginning of a trend. They happen during pullbacks. Think about it. When a market is trending higher, price doesn't move straight up forever. It pulls back. It consolidates. It pauses. During that pause, the stochastic oscillator often drops toward the oversold zone. Then, momentum starts returning. That's when the bullish crossover appears. This setup tells you that buyers may be stepping back into the market. You're not chasing price. You're joining the trend after a temporary retracement. And that's exactly what many professional traders want. Rule 4. Divergence is more powerful than most crossovers. Now let's talk about one of the most valuable concepts in technical analysis: divergence. Divergence happens when price and momentum disagree. Here's a bullish example. Price creates a lower low, but the stochastic oscillator creates a higher low. Price is saying weakness. Momentum is saying weakness is slowing down. That's bullish divergence. Now the opposite. Price creates a higher high, but the stochastic oscillator creates a lower high. Price is pushing higher. Momentum is fading. That's bearish divergence. And this is where smart traders start paying attention, because momentum often changes before price does. Divergence doesn't guarantee a reversal. Nothing does. But it can provide an early warning sign that the current move is losing strength. Rule 5. Wait for confirmation. One of the biggest mistakes traders make is entering immediately after spotting divergence. Don't. Divergence alone is not a trade. It's a warning. You still need confirmation. That confirmation could be a stochastic crossover, a break of market structure, a trendline break, a support or resistance reaction, a strong candlestick pattern. The best traders stack evidence. They don't rely on a single signal. The more reasons you have for a trade, the stronger the setup becomes. Rule 6. Combine crossovers and divergence for high probability setups. Now we're getting into the setups that can really matter. Imagine this scenario. The market is in a long-term uptrend. Price pulls back toward support. A bullish divergence forms. Then the stochastic fast line crosses above the slow line. Now you have trend alignment, support, divergence, momentum confirmation. Multiple factors working together. That's what traders call confluence. And confluence is where some of the highest quality opportunities are found. Not because the trade is guaranteed, but because the odds are improving in your favor. Final thoughts. If you remember only 3 things from this video, remember these. Number 1, the stochastic oscillator measures momentum, not overbought and oversold conditions. Number 2, use crossover signals in the direction of the trend whenever possible. And number 3, pay close attention to divergence because momentum often changes before price does. The stochastic oscillator is not a magic indicator. No indicator is. But when you combine trend analysis, crossover signals, divergence, and proper risk management, it can become a powerful tool for identifying high-quality trading setups. The goal isn't to predict every move. The goal is to consistently put probabilities on your side. Because successful trading isn't about certainty, it's about stacking the odds in your favor, one trade at a time. If you found this valuable, hit the like button, subscribe to the channel, and I'll see you in the next video.